Hey, it's Macro Casebook. Let me be direct. If you missed Nvidia, and most people did, you're probably sitting there right now watching it run and asking yourself the same question everyone asked too late. Is there still a way in? Here's what I want to show you. The AI trade is not one company. It's a supply chain. And at the bottom of that supply chain, literally in the floor and ceiling of every data center being built right now, there's a problem that nobody talks about: heat. Nvidia's Blackwell rack-scale systems require around 120 kilowatts of cooling capacity per rack. That's roughly the same as running 45 household ovens simultaneously. In a single rack, you cannot cool that with air. Physics won't allow it. So before a single AI model can run, before a single token gets generated, before any of the $650 billion in big tech infrastructure spend this year produces $1 of revenue, someone has to solve the heat problem. That someone is not Nvidia. By the end of this video, you'll understand 3 layers of this trade: who's winning the pure cooling play, who's winning the power and cooling stack, and where the valuation risk actually sits, because this isn't a free lunch. Let's go. To understand why cooling became a serious investment thesis, you need to understand what changed. 5 years ago, a standard data center rack consumed 10 to 15 kilowatts. Air conditioning worked fine. Today, an AI-optimized rack running Nvidia's latest hardware runs 120 to 150 kilowatts. That's a 10 times increase in heat density in 5 years. And it's not slowing down. Nvidia's next-generation Rubin Ultra platform, coming in 2027, pushes those numbers even higher. Traditional air cooling has a ceiling. Physics sets it at roughly 30 to 40 kilowatts per rack. Above that, you need liquid coolant distribution units, direct-to-chip cold plates, immersion tanks. The entire thermal architecture of data centers is being rebuilt from scratch. Microsoft is doing it. Google is doing it. Amazon is doing it. And the companies supplying that infrastructure, they're sitting on order backlogs that extend years into the future. This is not a speculative trend. It's a constraint. You physically cannot run next-generation AI compute without solving this problem first. Let's start with the 2 names that are most directly in this trade: Vertiv. If you've never heard of Vertiv, here's the one-line version. They make everything that keeps a data center alive: power management, thermal management, monitoring. Think of them as the circulatory and cooling system of the AI factory. The numbers are hard to ignore. Revenue in 2025 was $10.2 billion, up 28% year over year. Fourth quarter 2025 organic orders grew 252% year over year. Backlog hit $15 billion, up 109% from the prior year, with a book-to-bill ratio of 2.9 times. For context, a book-to-bill ratio above 1.0 means demand is outrunning supply. 2.9 times means demand is nearly 3 times what they're currently delivering. Management guided 2026 revenue of $13.25 to $13.75 billion, 28% growth again. Adjusted earnings per share guidance for 2026 is $5.97 to $6.07, implying 43% earnings growth year over year. Vertiv is also an Nvidia partner. They co-developed cooling reference architectures for Nvidia's GB200 NVL72 systems, which have become the industry standard for large-scale AI deployments. And on March 23rd, Vertiv joined the S&P 500. That's not just a headline. It means every index fund on the planet is now a forced buyer. Now the risk. The stock is up over 190% in the past year. It trades at roughly 35 times forward earnings. That is not cheap. Any execution slip, any delay in converting backlog to revenue, moves this stock hard and fast. Vertiv is the blue chip version of this trade. High quality, high price, real execution risk baked in. Modine Manufacturing. This is the one most people haven't heard of yet. Modine has been in thermal management for over 100 years. But in the last 2 years, they made a deliberate pivot, shifting their core focus to data center cooling through their Airedale by Modine brand. The data center segment has grown at a 93% compound annual rate over the past 2 years. Let that number sink in. Management is now targeting more than $2 billion in data center revenue by fiscal 2028. They've raised their fiscal 2026 guidance twice. Current guidance calls for data center revenue growth of more than 60% this year. And they just announced a $100 million manufacturing expansion specifically for you, data center customers. Here's the structural angle that makes Modine interesting versus Vertiv. Modine is becoming a pure play. In January 2026, they announced a spin-off of their performance technologies segment. the automotive and industrial business, to merge with Gantherm via a reverse Morris Trust. Once that closes, Modine becomes almost entirely a climate solutions company, focused on data centers and commercial HVAC. The valuation gap relative to Vertiv is real. Modine trades at roughly half Vertiv's earnings multiple, with comparable data center revenue growth dynamics. The risk? Execution. They're ramping 4 new chiller production lines simultaneously, expanding manufacturing capacity by 125% over 2 years, while also completing a major corporate restructuring. That's a lot of moving parts. But the order book is there. Management says record order intake is roughly split between chillers and broader data center products, with visibility extending approximately 5 years forward. If Vertiv is the established leader, Modine is the high-conviction smaller bet with more upside and more execution risk. Here's something most cooling-focused analyses miss. In a modern AI data center, power and cooling are the same problem. You can't thermally manage a system you haven't powered correctly. And the power density required for AI compute creates its own thermal footprint. That's why the second layer of this trade is the companies that sit at the intersection of both. Eaton. Eaton is a power management giant, $60 billion in market cap, that has been systematically repositioning for AI infrastructure. In 2025, Eaton acquired Boyd, a liquid cooling specialist, adding roughly $1.5 billion in projected 2026 liquid cooling revenue in a single deal. They paid $9.5 billion for it, a big bet. Third quarter 2025 data center sales rose 10% to a record $7 billion for the quarter. And the company's CFO said in a recent call, CPUs are cool again, and that was before the full AI compute build-out hit their order books. Eaton is not a pure play. It's a large, diversified industrial. But if you want AI infrastructure exposure with a more defensive valuation profile, Eaton gives you that alongside a reliable dividend. Schneider Electric. Schneider is the European equivalent of full-stack data center infrastructure provider. Power, cooling, software, modular data centers. They have deep hyperscaler relationships. Microsoft is a major partner. Schneider is less talked about in financial media, simply because it's a French company listed primarily on Euronext. But the business exposure to AI data center infrastructure is direct and substantial. Nvent Electric. This one is smaller and more concentrated. Roughly 30% of Nvent's revenue is data center related. Nvent has been collaborating on Nvidia-aligned liquid cooling deployments and reference architectures. In third quarter 2025, Nvent's data center sales grew 35% year over year. The third layer is the one that takes the longest to show up in a stock price, but it may be the most durable. Someone has to physically build these data centers. Comfort Systems USA. Comfort Systems is a mechanical and HVAC contractor, not a manufacturer, a builder. They install the systems that Vertiv and Modine make, and right now they are drowning in data center project work. The company's technology segment, which includes data center construction, has been growing faster than the rest of the business. Backlog is at record levels. Margins are expanding. This is the picks and shovels play one layer further down. You don't need to pick the winning cooling technology. You just need to believe that a lot of data centers are going to be built, and someone has to do the physical construction work. Carrier Global. Carrier is a late-stage entrant to data center cooling. They're better known for residential and commercial HVAC, but they've been systematically moving into the data center market. The caveat here is honest. This is a 3 to 5 year story. Meaningful data center revenue for Carrier requires sustained execution over time. If you're looking for near-term data center revenue inflection, Carrier is not it. If you're looking for a large, diversified industrial that's positioning correctly for the long run, it belongs in the conversation. Here's where I'd be doing you a disservice if I moved on without being direct. This sector has already had a significant run. Vertiv is up over 190% in the past year. Modine has had periods of sharp pullback, even as the thesis held. Eaton trades at a premium to its historical multiple. The risk map looks like this. Hyperscaler and housing. Microsoft, Google, and Amazon are all developing proprietary cooling solutions. Microsoft's Sidekick system. Google's direct liquid cooling at scale. Every job that moves in-house is a job that doesn't go to Vertiv or Modine. This is a real structural risk over a 3 to 5 year horizon. Technology displacement. Microsoft is exploring microfluidics cooling. If a dramatically more efficient alternative to current liquid cooling becomes commercially viable before these companies have fully monetized the build-out, the cycle could be shorter than the valuations currently assume. Valuation at execution. Vertiv's $15 billion backlog is the key demand indicator in this sector. But the real question is how efficiently it converts into revenue and at what margin. The honest summary. Just like any structural trade, it's not about calling it perfectly. It's about knowing what to monitor. Signal 1 Hyperscaler CapEx commentary. Every quarter, watch Google Cloud, AWS, and Azure calls. If management tone on data center build pace accelerates, the cooling and power infrastructure order books grow with it. If CapEx guidance gets pulled, that's your first warning. Signal 2 Vertiv backlog conversion rate. Vertiv's $15 billion backlog is the cleanest leading indicator in this sector. Watch quarterly revenue against that backlog. If conversion accelerates, the entire sector re-rates. If it slows, it tells you something is breaking in supply chain execution. Signal 3 Modine's chiller line ramp. Modine said they would have roughly 20 chiller production lines operational by early fiscal 2028. They had 4 commissioned as of third quarter 2026, 4 more targeted by fiscal year end. Watch these milestones. If the production ramp hits targets, the $2 billion data center revenue goal is credible. If it slips, the valuation case weakens faster than the headline thesis suggests. Here's where I'll leave you. Nvidia isn't the AI trade. Nvidia is one node in an infrastructure cycle that runs from chip to power, to cooling to construction. If you miss the chip, you can still participate in the infrastructure. But you need to understand what you're buying. You're not buying early stage discovery. You're buying mid-cycle execution. The demand is real. The physics are non-negotiable. And the companies building the thermal architecture of the AI era have order books that extend years into the future. The question isn't whether they win. The question is whether the current price already assumes they win perfectly. That's the homework. If this breakdown was useful, hit like. It genuinely helps the channel. Drop any tickers or topics you want covered next in the comments. I read them all. Subscribe and hit the bell. The next video goes deeper on Vertiv's liquid cooling roadmap and what Nvidia's Rubin Ultracycle means for the entire infrastructure stack. You don't want to miss that one. See you there.